Meet Ben and Maya. Today is the best day of their lives. They just signed the papers, they just got the keys. They are officially homeowners. The house cost $400,000. It's a lot of money, but they have a plan. They got a 30-year mortgage. The bank told them their payment is manageable. They think they just bought an asset. But Ben and Maya are wrong. They didn't buy an asset. They bought a liability. And they didn't sign a contract for $400,000. They actually signed up to pay the bank over $850,000. They walked into a trap that is designed to keep them poor for 3 decades. Today, we are going to look at the blueprint of a mortgage. I'm going to show you the math the bank hopes you never calculate. And then, I'm going to show you how to beat them at their own game. Let's look at Ben's first payment. He writes a check for $2,400. He feels good. He thinks, okay, I just paid off $2,400 of my house. But he didn't. This is the mortgage lie. Out of that $2,400 check, only $400 actually went to paying for the house. That is his equity. The other $2,000? That went straight to the bank's profit. It vanished. It burned. In the first year of a mortgage, you aren't a homeowner. You are a renter who pays for his own repairs. You are renting the money to live in the house. The bank knows the math better than you do. They front-load the interest. They make sure they get their profit first while you take all the risk. Bankers call this amortization. It sounds fancy, but here is the plain text definition. The kill schedule. The root word mort literally means death. Let's look at the structure of this trap. When you start, your loan balance is huge. Because the balance is huge, the interest, which is a percentage of that balance, is also huge. Every month, the bank calculates the interest daily. They take that cut first. Whatever scraps are left over, that applies to your loan. In the beginning, the scraps are tiny. It takes about 15 years, half the life of the loan, before you start paying more for your house than for the bank's profit. 15 years of treading water. So, is Ben doomed? Does he have to accept the $450,000 in interest payments? No. There is a flaw in the bank's system, a loophole. And it's not refinancing, it's not winning the lottery, it's simple math. The strategy is making one extra mortgage payment a year, applied strictly to the principal. Remember that first payment? When you pay your normal monthly bill, the bank eats most of it. You only keep the tiny sliver of equity. But when you make an extra payment directly to the principal, there is no interest attached to it. The bank doesn't get a cut. 100% of that money attacks the debt. Because you lowered the debt balance faster, the next month's interest calculation is lower, which means more of your normal payment goes to principal, which lowers the balance even more. It starts a chain reaction, a positive compound effect. If Ben and Maya make just one extra payment a year, that's roughly $200 extra a month. Look what happens. They cut 7 years off their mortgage. 7 years of freedom. 7 years where they don't have to write a check to the bank. And the money? On a standard $400,000 loan, that one simple habit saves them roughly $68,000 in interest. That is tax-free money in their pocket simply because they understood the structure. The bank builds its wealth on your patience. They rely on you paying the minimum. They rely on you being passive. Be the architect of your own wealth. Don't let your debt drift. Attack it structurally. This is just one blueprint. There are dozens of hidden structures in your financial life that are designed to keep you paying more and owning less. If you're ready to stop guessing and start building, subscribe to Plain Text Finance. We translate the confusing world of money into simple, actionable steps. Join us, and let's build your financial freedom one blueprint at a time.